Our next guest, Samit Vartak, is joining us this morning. Samit, good to have you with us. It's continues to be a bit of gloom and doom. I mean, if you're sitting in Bombay, the weather is adding to it as well, frankly. But we've had slowdown concerns. Nomura, the latest one to jump on that bandwagon, talking about short-term despair is the word that they've used, in fact. And we started to see that heavy selling coming in on the equity markets as well, in line with that. Are you also a proponent of the current doom and gloom scenario, or are you seeing some kind of silver lining that we are perhaps missing?
Hi, good morning. Yes, I think markets go through perceptions and extreme sentiments. I think in December 17 we were at the other end. Today probably we are at the lowest end, and this is I think the lowest sentiments that at least I have seen since 2008-9. So no question, I mean, the economy has slowed down. There are various factors for it. We have spoken about that, but I think you got to put things in perspective. Investment is for the long run. What are the things which are happening in the markets? I would say there are multiple positive things, right? So imagine the rating agencies now probably moving more towards realistic ratings. The auditors, being penalized or being threatened to be banned from the country, and them also probably auditing the statements much more realistically, which they should have been doing, but somehow wasn't done. And then the banking system, these sort of consortium was the one which created the excesses into the system. But the beneficiaries were the promoters who were able to play the system well, and not the promoters who were competent. I think these changes in the long run will make sure that the competent promoters have a level playing field, and those are the ones who would probably excel going forward. After this cleanup, whichever companies remain will be much stronger. They probably will become much bigger multi-baggers, because a lot of the weaker companies who survived because of basically leveraging these loose ends, I think they will be losing business. They will be giving away their market share. But yes, this transition phase, which is like a detox, is painful. But I think look at the long run. India has great entrepreneurs, and probably a lot of competent entrepreneurs were suppressed in this time because they didn't want to play this system, and probably didn't have the ability to play this system. They probably just knew how to run the business best, and they didn't succeed in this kind of environment. I believe going forward, as the environment improves, these are the kind of entrepreneurs which will deliver, and it's great for the country in the long run.
Sure. Okay, so if we're looking at a longer run scenario, Samit, first of all, let's talk about the fund flow picture, because we're waiting out for that Fed move, and correspondingly what we see from central bankers around the world, including back home. In terms of the flow picture, in terms of momentum currently, let's say over the next few quarters, how are you expecting things to shape up?
Yeah, so I think markets are completely today driven by flows, and unfortunately the buyers have vanished. So even if you have one or two sellers in a stock, the stock gets impacted by 10, 20, 30%, irrespective of what the fundamentals are. There are companies who have come out with great results, but getting impacted just because of the liquidity, and that's what happens at the extreme of the market. I am glad that at least the volatility is returning to the market, because typically that signals the towards the end of the bottom, because until now it's been pretty smooth slide, and that's always scary. So the markets is pricing in so many negatives, that we were just at the time of election, at the time of results, we were pricing in probably a 10% kind of a GDP growth, and post this budget, we probably are pricing in 4 or below that kind of a GDP growth. The valuations today that I see, obviously they're not anywhere close to what we saw in 2009, the worst of cycle, but they are close to what we saw in 2012. So they are pretty attractive, especially if you leave out the top 100 stocks and go below that. And if you say leave out the B2C kind of business, the business to consumer kind of companies, the B2B businesses probably are trading pretty close to what they traded in 2011-12, and which were extremely attractive valuations. So I believe that we just need few positive trigger points. I know that there are many investors who are sitting in cash. There are a lot of fund managers sitting in cash. A lot of money is on the sideline, but no one would want, or no one dares to enter this kind of a market and catch the falling knife. I think the market needs to hit some sort of stability, and that's where we will get the courage to come into the market. I think few other points I would like to make. Until July, August of last year, the base was sort of against us. After the IL&FS crisis hit in August, September, the base went low. I think that's the phase we will enter post August. So September, October, November, and that's when we hit the festive season. So at least in terms of comparison, we would be having a much favorable comparison, and I'm pretty hopeful. I think the liquidity situation this time around would be much better than what existed last festive season, and we could see some positive signs. And if that is to happen, the valuations are so attractive, the levels are so low, I think that might be a trigger for the markets to probably start going up.
Interesting, Samit, that you talk about this B2B cluster. But again, it's far and wide. There are many names in there. Anything in specific that you're looking at? Would it be, again, a very stock-specific approach, or are there various sectors where you see these kind of opportunities emerge? If you could just, be a little more specific than that.
Yeah, so yes, so I am a bottom-up stock picker. I would say, look at, obviously I've been, fan of specialty chemicals for a long time, so I won't speak about that. But do look at the B2B businesses which are more towards the building materials, say, which may be towards infrastructure or commercial building or residential building. Those are doing pretty well, especially where the market is not that scattered, where there are only one or two leaders. There are many weaker players, who are going out of business. So, one of the companies that we like is into steel pipes, and I've seen that, because I live in Pune and travel a lot from Pune to Bombay. From Pune to Bombay, there were at least 20 smaller players who have shut shop in the last 1.5 year post GST, and because of that, the leaders, they are still growing at 25-30% top line, and this is how I think it's a sign of what lies ahead of us. There are many smaller players in multiple industries, especially in B2B businesses, which may not be able to survive, and they will be ending up giving away their market share to the leaders. I think if we focus on those and just ride this volatility out, stop looking at prices, just to keep your mental stability, and you'll be fine. Just make sure you're not into one of these weaker players who probably would not survive this downturn.
Easier said than done, perhaps. But Samit, let's also talk a little bit about the trajectory for the broader end of the market versus the large caps from a valuation standpoint as well, because we have seen that off late the small caps have been lagging the most in the last 5 years. So what, according to you, is driving the conviction that we could see lesser risk in the mid and the small caps versus the large caps?
So in terms of business, I think there is a misconception that large caps are the safest in terms of their business model. Even they can be disrupted. What we are seeing in the auto sector, right? So even the large caps have been equally hit. So I think you got to focus on businesses irrespective of where the market cap lies. It's just that the entire universe, if you leave out the top 100 companies, has been penalized, and they are trading. I mean, I was just looking at the median valuations of this range. So the top 100 companies median valuation is anywhere from 26 to 27 times. Once you go beyond 250 companies, the top 250 companies, that's when they have been decimated. Once you go beyond 500 companies, the median, so 500 to 1,000, their median valuation is in single digit today, below 10, and that's happened after, I would say, at least 6 to 7 years. It's just that the valuation, if you find the right leader, irrespective of whether it's a large cap or a small cap or a mid cap, if you're getting it at a single digit P multiple or low double digit, there are many companies, many leaders. The one I spoke to, even they are trading at 11, 12, 13 times. I'm pretty sure if one of these companies were in the top 100, just because of the liquidity that's flowing into the large caps and just because of the performance of the large caps, they would be probably trading at least double the valuation. And just the valuation attractiveness is where you should look at. That's where people are running away from, and that's where you should be running into. Obviously, it's not going to be bottom. It's extremely difficult to pick the bottoms, but you got to ride through this volatility. What you have probably given up in the last 3, 6, 7, 8 months, once the market stabilize and the money which is lying on the sideline comes in, you can recover that in a matter of few weeks. That's what you should be aware of. Just look at the previous cycles, whether it's the 2009 cycle. At March 9 was the lowest for the market. From March 9 to June 15, the small cap indices and many of these companies more than doubled. Similarly, it happened in 2012-13, in that cycle. So the jumps are pretty volatile, and if you are not buying during these low, sentiment times, you do not get the opportunity. I know that you will probably feel more painful if you lose 10% more or 15% more, but that's how markets work. You got to jump in, when people are running away from that space.
Okay, just want to mark the market for a moment, Samit, because, yet again, day after day, as we're accustomed to, we're staring at these deep cuts, now just about 12 to 13 points away from breaching the 11,000 level on the downside, 200 points off on the Sensex, and yes, far worse for the broader end of the market. Real estate, metals, media, FMCG, IT, you name it, all of those sectors have been badly hit, including, of course, the banks, which are taking it in the chin. Let's also, Samit, at this point, just get in your view as to, some of these deals really being concluded, say DHFL, maybe we see something happen with Z as well. You were talking about investing in some of the debt-free companies led by good margins. These, some of these companies, I'm not taking any names, they do have a strong fundamental strong fundamentals and good balance sheets. Do you think that with some of these deals concluding that could really change the picture, that some of them will now start to see the light of the day and the volatility could be behind?
I do believe so. I think companies who are able to raise equity, especially in the NBFC space during this time, and especially if they are able to do so through really high quality investors, it should give a lot of confidence to the investors, and it will probably allay a lot of fears that are in the market, because when they put in the equity, they have much better insights into the business, because they their due diligence, they hire people and they have much better access to the internals of the company, as well as the various exposure to the risk assets, and if they are coming in at these kind of times, it should definitely give you a lot of confidence, and I believe it will definitely lower the volatility. You got to go through this phase when it is more liquidity driven, but once investors start focusing on the fundamentals, people will realize that the smartest of investors, when they're investing, they are taking a much more informed view about that company.
Right. Okay. Samit, so if you were to look at, in terms of just the portion of your portfolio that you feel that in a market like this, would you perhaps stick to perhaps the safer bets? Would you stick to the financials, maybe the consumption side? Would you look deeper into utilities or infra? How would you really shape up the portfolio or suggest to someone who's getting into things right now or at further lows, with an eye on things to come?
Right. So see, unfortunately, most of the investors would be already invested. So it's not that they are just starting to invest. For someone who's starting to invest, it's a no-brainer. Just start buying and probably build a portfolio in the next 3 months. But for someone who's already invested and probably stuck with some companies which haven't done well or aren't doing well, they are not leaders in any of the segments. They are the inferior players within that industry. I think this is a time to shift to the leaders. I believe that you have to identify the most competent entrepreneur, the business who have significant competitive advantage within that industry, versus the competition, because whether it's the leader or whether it's the second player, in many industries they have been penalized equally. So this is where you get an opportunity. Don't worry about how much loss you have had, because you probably are getting into something where it has also corrected. But this is an opportunity you should not miss. Maybe you wait for the markets to stabilize, because you won't probably get the liquidity to get out in many of these stocks. But it makes sense, even if you are taking a loss of incremental loss of 5 to 10% more, just get out of a weaker company and get into the strongest in that sector. Just lose the anchoring bias. Don't worry about your losses. It's a decision which may seem painful today, but if you look at it from 2-year, 3-year perspective, you will see what a great opportunity this was. So I would not say that, I would just say that just look at individual companies, invest in companies where they are leader by a margin, irrespective of whether the sector is growing or not, because the majority of the growth will come from market share gain and not just because of the industry growth. Industry growth can sometimes be misleading, because it doesn't mean much. If there are multiple players who are able to come into that industry, that specific player may not be able to take advantage of the industry growth, because that growth will be spread across multiple players. Whereas if you go into an industry where the number of players are shrinking, even if the industry isn't growing as fast, the leader may be growing at much faster pace. And that's something that you need to keep in mind, because otherwise, if you stick with the weaker players, they probably would never recover.
Samit, as always, a pleasure having you with us. So, you are seriously advocating that there is opportunity in this market. You've spoken about how one should really navigate and pick out some of the winners within this space. Thank you so much for joining in and giving us your take.